Hello and welcome. Very interesting company today that we're going to be talking about. Stock is perked up over 10% in trade. They've won an 825 crore opportunity within the CDMO space. This is not something that Morepen Labs has done in the past. This gives the company the opportunity to not only lift margins significantly, but it gives them a foothold into the higher margin CDMO basket as well. So it could well be a large re-rating for the company. We'll try and understand this better. And more than just the stock price, we'll try and understand what the factors are at play. It's a 825 crore multi-year mandate which they've won. The mandate is for contract development and manufacturing from a leading global pharmaceutical company. The supply is set to start in 4 to 5 months. It's multi-year, and therefore the devil is in the detail in terms of the 825 crore revenue. How is it going to be split across how many years? But nonetheless, this is significant because what Morepen does in terms of top line is around 1800 crore of top line FY25. And therefore, even if this is split, for example, over 10 years, and if it's that large, it could still contribute 5 to 6% of top line right off the bat. So it is definitely big. And the second big piece is the CDMO piece, because that's higher margin. Indian companies have done very well. And therefore, Morepen trading at roughly 20 times earnings could well be something which could prove to be very interesting. Now, this is what I want to know. One is CDMO as contribution to top line. Not only FY27, I want to understand this in a slightly longer tenure or picture as well. What are the other opportunities? Are there pitches which are happening at this point within that CDMO space? Are they actively in conversations with other pharmaceutical majors? I'll try and understand that from management. The second piece is with regard to 5,000 crore revenue target. This was given for FY30. I'm going to try to understand whether this includes the CDMO top line or does not. Very likely it will. But what that will mean in terms of the split between CDMO, in terms of mix versus traditional business, and how much of this 5,000 crore will actually come from CDMO. That's what I'm more fascinated to understand, and we'll try and get a sense of that. The third piece is with regard to API's average selling price. Now, we've seen a fall, larger competition coming from China, impacting those numbers. Excuse me. And as a result of that, what we've seen is we've seen a contraction with regard to margins, even though volumes have gone up. Are we at a cusp of a turning point? Well, we'll try and understand that, because that will mean that traditional business is also turning around. And then you have some of these additional levers with regard to CDMO, and the business will likely then look very, very different 2 to 3 years from now. The fourth piece is with regard to timing of the margin recovery. They have guided for a margin recovery towards 15%. How much of that, I wonder, is baked in as a result of CDMO in particular, but even outside of that, how much of that margin will likely come through, and how quickly will it reach that 15% number? What are the levers available there is what I'd want to know. Demerger of the devices business, this has been in the pipeline for a while. We'll try and understand as to when that is likely to play out, and the new molecule visibility, at least over the next year. How is development going on that front? We'll try and get a perspective of that as well. Now, let's talk about the company. First, it was incorporated in 1984. It's a pharma company, manufactures API, formulations, medical devices into consumer health, and now into CDMO. So that's the pillars on which it's built. Operates in the pharma, med devices, and consumer wellness industries, if you're looking at it top down from an industry perspective. APIs, now let me try and break this down. What exactly is API? It's the core chemical substance. It's that ingredient which prevents or treats disease. That part of the medicine is called API. So API is manufactured by Morepen, and some of those APIs are in the anti-allergy, anti-asthma, cholesterol lowering, anti-diabetic, blood thinner, new cholesterol reducer, and novel fatty liver treatment. In that line of treatment is what they generally manufacture APIs within. They also do finished formulations, which is ready-to-use medicines, which are generally the end product. And finished formulations by Morepen within the categories is diabetic, cardiac, basically tablets to prevent strokes, and gastro-related. That's broadly the pillars, again, under which they sell their products. So that's the broad base with regard to their products. Let's talk about over-the-counter or consumer health, the OTC business, as one would call it. Then for that, there's Bernol, which is for burns, of course. There's Lemonade for cough, cold. Light Life for weight management, and then there's omega-3, wellness, oral care products, and the like. So you've got all of those products which they are in, where consumer health or OTC is concerned. Last piece is with regard to medical devices. Before I come to CDMO, in terms of medical devices, they are into checking blood glucose, blood pressure, of course, BP, nebulizers, thermometers, ortho, but a large chunk of that is blood glucose, which is the medicines to check for diabetes and blood pressure. So that's broadly the devices that they manufacture, which is Morepen. Now they are, of course, heading into CDMO, and we'll try and get a sense on all of the questions that we've asked. In terms of geography, 9-month FY26, that's the geographic split. In front of you, India is 62% of the business, Europe is 17%, rest of Asia is 13%, US is 6%, and South America is approximately 2%. That's really the split with regard to the business. Now let me talk about the financial metrics of the company. We'll try and run through this. The revenue growth over the last 3 years has been at just about 5%, so far from enthusing, right? But really pricing pressure, which I spoke about at the start, weighing down on these numbers. Even though volume growth has come, it's really the price pressure that's playing spoil sport here. EBITDA growth has also been at just about 8% on a YOY basis CAGR over the last 3 years, and net profit has again grown at just about 5% CAGR, so not really looking all that strong. In terms of the 9-month FY26 period, we've seen a flat growth on the top line. EBITDA is in fact down. Pricing pressure is weighing in, and you're seeing margin contraction, and profitability is in fact down 12%. Net profit has been impacted by one-offs as well. There has been a strong other income in Q2, which has led to that net profit not being as badly suppressed as the EBITDA has been. When you're looking at margins, we've seen a recovery come Q3. So Q1 was extremely difficult, 5.6% margin in Q1, 7.5% margin in Q2. But Q3, we've seen margins lift towards 9.5%. So we've seen a bit of a lift with regard to margins in Q3. And likely that will only continue to get better going forward as well. So that's on the margin front. But again, it's difficult at this point. But with this turnaround, CDMO and the like, this story could well change. Really, that's what you're trying to understand. Whether the story here, the last 3 years, changes substantially going forward, because then the valuation should also re-rate. And we'll come to valuations in just a bit. The balance sheet now, in terms of the equity, it's at around 1,200 crore book value. At the end of H1 FY26, you can see the borrowing number being extremely low at just about 140 crores, so no concerns where the balance sheet is concerned. When you're looking at cash and bank balances, they've got around 40 to 50 crore of cash sitting in that balance sheet as well. So no concerns with regard to balance sheet strength. You're looking at cash flows. They haven't come through. In fact, we've seen cash flows getting stuck in various places, especially working capital, and that's why this not looking as good. We'll try and see whether the unwind on this actually happens or not. We'll try and get a perspective on that. Return ratios, well, you'll see the return ratios have been quite decent. Even in difficult years, it's dropped to a single digit, but outside of that, it's been fairly okay. Mid-teens, and in good years, it's been 20% plus as well. So can the cycle turn is really the question. And if it does, what changes this time around versus past cycles? Are they able to manage the down cycle better, given the CDMO business with better visibility? Well, if that changes, again, you could well see changes happening going forward. When you're looking at shareholding, you've got around 36 to 38% held by promoters. FIs hold and DIs hold very small portions. The rest is held by the public. Public holding has gone up. The number of shareholders have also gone up. That should keep you cautious, because the number of shareholders going up means that there is more frenzy around the counter, which is something that you must note. So that is one thing that we'd be cautious about. But outside of that, 36 to 38% is the promoter holding at this point. You look at what the management guidance indicates. Management has indicated a working, or they've worked with around a 10 to 15% growth on the top line for FY26. They indicated that at the end of FY25. They've not guided for it. They've indicated for it. They've been working with 11 to 12% kind of margin number, which is compressed currently. The medium-term margin target that they've said or set themselves for is around 15%. The FY30 revenue target we spoke about is 5,000 crore, and they're targeting a 20% growth on the top line in the medium term. So again, that kind of gives you the texture. Now, in terms of valuations and where we stack up on right now, the 1800 crore top line number leads us to a 2000 crore top line number FY26, 2200 crore top line number FY27. If the 10% growth is maintained, CDMO included likely for the moment. The margins, if they're left at 11%, that on a conservative basis will mean the margins which are unwinding on your screen. And what you'll therefore see is a net profit of around 135 crore, which is FY26. That 13 crore number is incorrect. And then you've got a 150 crore net profit in FY27, which leaves us with a price to earnings multiple of approximately 17 times. And for a CDMO company, that doesn't look too bad. So let's try and bring in Sushil Suri, Chairman and Managing Director at Morepen, to give us a better perspective of everything we've spoken about. Mr. Suri, great having you. Let me first start off by understanding the CDMO piece. This 800 plus crore kind of, firstly, many congratulations on the win, because it's a big one, right? It's a sort of inflection point for a company like you. Give us a sense as to how long is the contract for, sir? And does this, is this at materially higher margins? Is it maybe 20, 25% plus in terms of the margin expectation on this kind of top line that you'll clock?
So Harsh, basically, let me first clarify, and of course, thank you for giving us an opportunity to speak today. So it's naturally a historic moment for the company. So this particular order is a one-time order. It's a single order, not a long-time supply contract. This single order is for 15 months. This is a 800 crores orders for 1 year supply. So when you say multi-year, means this kind of orders will be repeated year after year, and if we do it well, and of course, this can always increase. So this is multi-year in the sense that this kind of orders will be coming regularly. That's where the multi-year is. It's not a 10-year, 5-year supply contract. It's to be supplied within 1 year. And the supplies would start in the Q2 of this year, and we will try to finish by Q1 of the next year. So basically Q2, 3 quarters plus 1 more quarter. So though we have 15 months, so we'll try to complete it within 12 months. That's where it is. And certainly the major change, what it is saying is that earlier what was happening was it was more of a, I would say, preparation time, and last 4 decades we have worked hard, but we had built the foundation of compliance, regulatory, manufacturing skills, quality controls. Now that foundation has come out of above the ground, and we are scaling it to in a more structured way. Earlier, it was all more spot business, more one-on-one customers. So now it will be more structured and regulated business with long-term values.
Understood. So you're telling me, sir, this 825 crore is actually going to execute, is actually going to get executed over the next 18 months, right? Starting today.
18 months.
Next
yeah,
4 to 5.
Starting today, we say, yeah.
Starting today, 18 months. Next 4 to 5 months will go in prep, and thereafter you'll boot up the manufacturing and it'll add 800 crore to your top line over the 12 months thereafter. So after the 4 to 5 months lag, it'll add 800 crore to your top line. Well, that is large, viewers. Okay, point taken. And generally, sir, these CDMO orders are longer duration as well. So what's the likelihood of this continuing? And will it continue at maybe, say, an 800 to 1,000 crore kind of clip in terms of run rate?
Harsh, as you understand that these supply contracts are long-term, and naturally nobody does it for a single order. Certainly we have spent years building these relationships, and the customers today are realigning their global supply chains, and India is becoming naturally as a more preferred partner. And more importantly is that as a Morepen, we have passed all the qualifications and validations and everything in terms of compliance, regulatory, chemistry skills, and more importantly is the delivery schedules. So customers are more and more worried and disturbed because of the global geopolitical situation, which we all know. So obviously these things are long term, and I'm not saying that there are chances of repetition. This is how this business works. The whole story in this business is that, okay, these are long term and sustainable and more reliable, and we can see more visibility in terms of operations, we can see more visibility in terms of our timelines, we can see visibility in terms of our margins. So this is how these businesses are structured, and that's why they get higher multiples from the investor side.
How sustainable is your current top line, sir? Because this 800 crore adding to your current top line of 1800 to 2000 odd crore which is what your aspiration for FY26 ought to be, would it be over and above the kind of 1800 crore kind of top line that you will do,
Yeah, that's
and
what Harsh
therefore
today
will
is.
add meaningfully to your growth?
I would say, looking at the pure numbers, if we say, of course, I know media loves numbers, but looking at the purely at the numbers, it's going to double the revenue of API division, because API had been between almost the same range, 900 crore, 950 crores last few years, between 900 to 1000. So addition of almost 800 crore, I would say it will easily add up 60 to 70% in the first year itself. So it's going to double the revenues in a longer term. And as we go forward and as we inch toward our 2030 target, so certainly these revenues will multiply better, because we are hopeful and expecting. Because now we are talking of a single customer, single order. So obviously, when we go ahead and have more relationship with the same customer about same product and multiple products, and of course we are in communication with multiple other customers which are at early stage. So this is how. That's why we say this is a very big milestone in the history of the company.
Right. And what would the margin picture be like? Would it be first year lower margins, thereafter the margins will get better for you? Or is the margin picture really solid right from from year one itself? Are you investing upfront? What's the picture there?
Harsh, what happens is normally in these kind of long-term mandates, and these are customer-driven programs. So these are more, I would say, designed for operational efficiencies. So operational efficiencies, clear visibility, better supply chains, and everything adds up. If you have better supply chain, you have long-term supply contract with the vendors, you have operational efficiencies, we can afford more automation. So everything adds up. So I'm not saying that X margin or Y margin. You know what kind of margins these CDMO companies have.
Yeah, absolutely. Okay. But that is in the medium term, sir. Right off the bat, is there any indication you can give us? Will it be just about double digit? Will it be margin accretive for you from year one itself?
Look, I would say the moment the supplies start and we have additional business generated, so certainly the margin would increase, because the operational expenses would remain almost same. I won't say same. Operational expenses, keep assuming, will not increase substantially. Operational expenses will not increase 100%. So of course there would be increase, but I think let the time come. So it's too early to talk about Q2 next year.
Sure. On your existing business, sir, you've spoken about margins inching towards 15%. You've spoken about how pricing will likely continue to improve going forward. How confident are you, and how quickly can that happen? Talk to us about both of those, because you've done well on volumes. It's just the
That's
value
right.
that has hurt you.
That way, Harsh, in the existing API business, we all know that there had been a lot of a global headwind for or against India, China, tariffs, and whatever thing. So there was a disturbance, but we have a solid foundation of regular customer base, great marketing, long-term relationship with the customers also there. I think the only issue is the pricing part, which as a long-term thing in API business, it is not uncommon to have price fluctuations. But ultimately, we have to clean up the portfolio. We keep adding new products. We have a lot of new things to offer. But I would say in the existing products, we would still remain in the same range, maybe 11 to 12%. But the CDMO flavor, maybe it will be in the high teens. So an average margin will certainly be mid-teens, I would assume, to begin with.
Mr. Suri,
Without
on the 5,000 crore top line target in FY30, what's the split between CDMO versus your current business? Give us a sense of that. Also, when does the demerger take effect? Give us a sense of that as well. And if I can throw in another question with regard to new molecule visibility, how much of that plays on to that 5,000 crore top line?
Good. So I would say let's do the first question is that 5,000 crore remains intact. And of course, the 5,000 crore number is driven from typical what we were earlier running at a CAGR of 20%. At 20% CAGR, we are confident that we get 5,000 crore. But obviously, this surprise element of CDMO may push the number a little higher. So we haven't done actually the right math, and let's leave it at 5,000 crore. But the CDMO certainly will be much higher. As far as your question on the new molecule of APIs is concerned, that I would say is a part of the growth which is included. And typically, when we talk of 10 to 15% growth in the running API business, So obviously, new molecules will be increasing. The share of new molecules will go up. Existing old molecules stay as where it is. And coming to your third question, which is very important, is the medical devices. We have already taken shareholders' approval. We are waiting for some regulatory approvals from our local state authorities. So that is also on the cards, and the coming fiscal, you would see that also coming up.
Would you say, sir, 40% of the 5,000 crore top line will likely be CDMO? Is that what we can expect?
Could be more, but let's stay at 40%. You guessed it
Okay.
right.
Point taken, Mr. Suri. I'll leave it at that. Thank you so much for that visibility, and many congratulations once again on the win.
I would like to add only one thing, that this news is not of a one order or a one kind. It's basically a structural shift from a
Sure.
routine spot business to a long-term strategic call, more structured business, more operational efficiencies, better planning, and of course, better margins. That the whole strategic review, but what it is coming. It's a transformation of the company to the new model and realigning with the global supply chain shift. So we are realigning with the shift wherever it is happening, and it's all happening in favor of India.
Okay. Mr. Suri, we leave it at that. Thank you so much for coming in and giving us that perspective.
Always a pleasure.
And viewers, that's all the time we have on AAYC today. Thanks so much for joining.